Welcome back to the channel. I hope you're feeling happy and healthy wherever you are around this beautiful planet of ours, leading into a special holiday period. Guys, today's video is a major update as we finally have the last major news announcements from the US coming through to the markets. This is part of the bottoming process that we have been anticipating and following this whole year. 2022 was going to be a tough year in the markets. We looked at that earlier in the year based on cycles, based on what has happened in the past in terms of how fast prices run up, and then looking at when this timing could actually play out. You can go back, check out the videos during your Christmas breaks. This has been playing out to an absolute T, and major recessions are probably not likely. We still have a little more data to come out, but what we'll get through in today's video is the major signals that are coming up here on the chart. Absolutely incredible. So before we get cracking with the update for the macro picture, like, subscribe, do all those good things down below, click those like buttons, tap them, do whatever you need to do. Let's dive straight in. So the last piece of news here, the interest rates went up 0.5% in the US, now at 4.5%. This is the target rate that they will be looking forward to. And then into 2023, Powell still says we're going to look to see some extra interest rate rises, but they're looking like they're starting to slow. We went from 0.75% for multiple rate rises now to 0.5%. Potentially what the market is anticipating is 0.25% rate rises into 2023, bringing us up to about maybe 5.25%. So that might be 1, 2, 3 more interest rate rises of the smaller degree here. And then in about 12 months time, the market looks like it was anticipating maybe a reduction. We'll see. But the stock markets can handle the interest rate remaining stable. They can do it. They have done it in the past before any sort of dramatic crash. Now, I'm not a perma bull. I'm just an investor and a trader. I've been in the markets for over 16 years. We've seen this play out before. I was in the markets during the last peak in 2006. I might look young, but I'm actually a little bit older than that, coming up to 37 years old. I bought my first property at 20, and I was in that last boom stage of 2006. Similar sort of things happened at that time. Right now is not the dramatic depression crash like the GFC that everyone is anticipating. Let's take a look further at that in the charts themselves. So we're going to go into short term and a bit longer term here in these markets, because what we've just seen is the interest rate rise. The markets had anticipated it, and it really hasn't done too much to the price so far. We've basically just stabilized between 3,900 and 4,100 points on the S&P, obviously the biggest market in the world. We need to know what's going on here before we can get across to Bitcoin and ETH as well. So let's figure out first whether this is a time to be super excited like I am, or whether we need to get into our depression gear and fear the rest of the world is about to implode and be done with for the next several years. You know, there's always these two extremes to the market, and that's what most people are fearing. You know, I've got a couple of comments on that. We'll get to that later in this video. To the downside, the same thing is in play from yesterday. You can see this little mini double top here on the daily. What I've written here on the chart is a safe area for the market to fall. It's our 50% around 3,800 points, and it's also an extension of the double top. So it's a good downside target to trade this market short. It's not financial advice, but this is what people would be looking at, somewhere around this 3,800 point level. Anything down to that point, you're going to hear the media go crazy. You know, we're about to fall, you're wrong, this, that, the other. But this is a safe level for the market to come back to. It's basically like a soft landing for this market, if you want to use those terms. Now, underneath that, anywhere under about 36 is a danger zone. So we'll be coming back to test this old low in October. But if it holds up at 36, that's a good sign. So they're the two targets, the major ones. We've looked at some others, but these are the major ones. And why? Should we hold above 39 and start to break out to the upside, that's even going to be stronger for this particular move. Now, taking a look at the E-mini, this is the major contract that traders trade. This has got the volume on it, and this is where you go to trade the SP500. We're looking at the last move from that October low. So this key October low that we were anticipating for a potential cycle low. So far, it's still intact. Everything is working out to be that cycle low. We have to put two different pieces of our minds together here, or try and pull them apart, essentially. We have one side, what are the investors doing? Because we want to get into the market as early as possible with the signs that we can see from the market. And then throw the other side, the fundamentals, the noise, the news, the fears of the economy going down, the recessions, and all of that talk about how bad things are for people in different parts of the world is completely different. I know I need to repeat that most videos because I still see those comments come up, and I'll go through a few of those after this. It's just natural to see that and feel that as if you are really expecting bad stuff to happen in the market, where in fact we might have a different story playing out here based on what people are actually doing with their money. What we're interested in is what are people doing with their money, not what they're feeling and not what they're experiencing in life. That's for a different time. Okay, so with that in mind, the move up here is very, very similar. It's 1 day longer in time and 10 points shorter in price to the previous move that we have been watching from the June low to that August top. So it's 688 and 60 days. So we've basically almost balanced to a T that previous move up from those lows. So this is not exactly where we want it to be. We want it to be a little bit higher, and hopefully over the coming weeks, we do get that push above and hit our target of 4,200. You know, we're just short of that in 2 days ago at 4,180. So the best case scenario is if we break above and then begin to consolidate above these levels of 3,900 and 4,000, above that bear market downtrend. That would obviously be a pretty clear sign for us that follow charts that we're starting to see a lot more strength in the market than what the news is telling us with a lot of the bad news that's out there. And unfortunately for the majority of people who aren't following what the price data is telling them, any sort of move down, they would expect further major collapses and recessions. So be prepared for that sort of news if it is to come out. So far, we're basically in this potential trading zone between that 4,000, 4,100 and the lows here are about 3,600 points. Let's continue to follow that up on the channel while we update the US dollar and its continued fall. 26th, I'll remind you again, on the channel nearly 3 months ago now, we looked at this as being a potential top before any of this data came into the downside. Moving up, everyone was fearful of the pound, the euro, things were going bad everywhere else. The US dollar, let's flee to the US dollar for safety. Of course, it always happens at those tops, and now the US dollar is down about 10%. So the peak there was 114.8, and we are now down at 103.5, so 9.87%. Remember, this level was very key for us around 104. It hovered around that for a bit and continued to break down. So this is breaking down a little bit quicker than what I would have thought for the US dollar at this stage, but eventually we will have a turnaround. We've covered about a 10 to 12 week move down in a bear market, followed by a reversal. So don't be surprised if we go on these little reversals here. So you can see from the previous bear market, you get these moves down and then a reversal, down, reversal, down, reversal. If you count these times, it's approximately 2 to 3 weeks that you'll get a reversal move here. People will feel like it's back on for the US dollar, and the move continues on from that point. That leads us over to BTC, and crazy, this shouldn't be happening at this time. We should be going to 12K or 10K or even further. We've now broken into step 2. Remember, we had our multiple steps here for the market to hold, consolidate, and break above. These help the market basically find support and confirm a price before it can then stair step to that next price. And basically, we've seen it go from 16s, break above that 16.7, hold, and then burst up again and break above the previous low, which was the June low, the 17.5 level that everyone freaked out. We all freaked out in November and expected this to go a lot lower after the FTX collapse. And, FTX was supposedly going to bring everything else down with it. But this may, not exactly, but it may be that final low. We're still waiting for further confirmation. That confirmation comes above these levels here, our Wyckoff bullish flips and our monthly swing tops. So somewhere around, the first one is 20,700. Another key level that we've had on the chart here for months and months and months. And then of course the flip above are around 21.5, going further up the chart, 23.2 and then 25.2. So if you were around in May of 2021, you would remember these Wyckoff bullish flip bars that I looked at, and this gave us a really key indicator as to how the market could what the market would do next. If it's not able to break these key bars, like these very specific bars and price ranges, it's almost guaranteed that the market is going to fall and not reach those higher targets. And we did this at $60,000 on BTC. The market was at all-time highs. People were calling for 80,000, 100,000, and we were looking specifically at very similar bars to this, saying if it doesn't break this top, it's never going to make that point. It got within a few $100s and then collapsed in May. All that's on the channel. And so I bring that up because this is another key sign again. This entire way down of Bitcoin, it was not able to break any of these Wyckoff bullish flip bars. And I probably hear you there saying, well, what are these bars? How do you figure them out? What do they look like? I'll get to that in just a sec. But you can see that Bitcoin was not able to break them and then fell. And then we have another couple of them here. It didn't, well, this is the first one here. It got within a couple of $100 of this next line and collapsed. The next one, we're now trying to attempt to get back to this top here, and that's around 20,700. The main thing about these bars is that they are change of behavior in the trend. You can see the market's tried to climb up, and then on this particular bar, the range is huge. The close of the bar is low again. Obviously, they're candles here, but I often use bars. And then the volume is also huge. So that gives us a key signal that the behavior in the market has changed. And if we're unable to overcome that, then we're not going to go up higher. And you can see the market attempts to correct itself, get back above. It fails, gets rejected, and it goes on another down leg. So it's a really good sign if you're ever trying to trade these markets long or short. It can give you that key signal, say, everything is looking very, very bearish. We're unable to overcome these particular bars in the market. So the short term, we've gotten rejected yesterday. We're attempting to remain above 17.6. The good sign is we have put on a little bit of a move here, 15% above the low price, the current cycle low. So it's a good sign so far, especially when people are expecting $10,000 and below. The main thing here is, should we start to break above 18.6, that's 10K. Again, you can start to wipe these things off your slate. You don't have to wait for these prices anymore. My bigger target is around 20,700 and this top here, which is the monthly swing top, 21.5. All right, so that's about the level. If we break that, 10K's off. We start to get above 18.6, the probability reduces a lot. So the calls of 10K are just getting ridiculous by that point. Sure, we could keep going down and maybe hit 14 from there, but because the market has climbed and begun to show further signs of strength, that means that we're probably not going to see those extreme downside targets. Those extreme downside targets need to happen when the market is in extreme fear. And unfortunately, it's not at that stage at the moment. Ethereum is just broken out of its bear market downtrend. Now, it is just short term. It's on the daily chart here. So we need to see some confirmation over the weeks or the months. What we've seen in the past is Ethereum basically lag Bitcoin. If Bitcoin puts in a low, Ethereum might put in a low a little bit later. If Bitcoin puts in a top, Ethereum might put in a top a little bit later. So we're still on the hunt for a potential final low, and just wary that this market could break down and give us another quick spike low somewhere beneath $1,000, hopefully 800 or 600, 700, $800. But overall, we're at least starting to see the market form its trading range like we've seen with Bitcoin. And so this is a good sign moving forward into 2023 for a little more stability, less volatility, accumulation period. Let's wait and see if we can get these final closes on the macro above some of these key turning points. I trust you are finding a lot of value from the macro content that we're putting out here. We've basically been pretty well on track, not to pat myself too much on the back here or give myself a bigger head, but the market has been trending pretty well in line with our time cycles, based a lot on the 18.6 year as well. So make sure you have liked and subscribed. And I do see that you guys are seeing some differences, which is great. And I just wanted to address a couple of those at the end. If you want to see more of it, let me know in the comments down below, and I'll answer one or two of the questions at the end of the videos coming up. So Jason N5196 says, we're still over 7% inflation, and that ain't going to improve with a 0.25% rate hike when the real target is probably 3%. Recession looks imminent. 7% year-on-year inflation is really unhealthy. The only light that I see is if wages rise across the board and our current prices become the new norm. But most people are going to be squeezed and things will probably get really tough. So this is probably different to what is happening in the market itself. And we're trying to make money from the markets, and we're going to follow what the charts do. This may in fact be true. People may find it a really tough time over the next few years as prices continue to rise, like on rents and property prices and maybe even food. But if we are trying to make money from the market, we need to put this sort of stuff aside. The main things that are impacting the markets is how much credit is created in the system and where are we in the cycle. Continue to follow those two, and that'll give you far more answers in trying to figure out whether the Fed is going to raise interest rates by a quarter or half to bring things down. Everything does matter to a degree, but not as much as where is the credit coming from, and of course, where are we in the cycle. I'll leave it there for today's video. Thanks again for all of your comments. See you at the next one. Till then, peace out.